Hi guys, today we're going to get a deep dive into dimensional funds. Dimensional funds is highly rated simply because it's low cost and they have actually a very solid evidence-based investment method. Today I'll show you a little bit of details just in case you're keen to get yourself invested. Now let's listen in on what Chairman has to say because these are very good investment principles. But before we get there, let me introduce to you Eugene Fama as well as Kenneth French. They are the founders of this concept, and they have and Eugene Fama has actually won a Nobel Prize for it. So now let's move on back to the chairman's statement. Listen to this because this has golden nuggets of wisdom with it.
You know what it is? I think in most endeavors, if you're smarter or work harder, more talented, have a little luck, you can do better than the next guy. That's not true investing in public markets, because in public markets, you're just swapping pieces of paper. In an aggregate, people get the market return. So if you have better than the market return, that means I have to have worse than the market return, or vice versa.
Yeah, so in markets, there is actually an aggregation. So it's very difficult always to beat the markets significantly. When it comes to new investors, especially when I was much younger, I was always looking to outperform market. I thought I could be Warren Buffett, but there's only one Warren Buffett. I've shared before many times in the community that Warren Buffett is unique. Most of us can actually achieve our financial freedom and financial goals, such as retirement, using a very slow and steady market return kind of approach. So now let's listen in to a second piece of good advice that I'd like to share with you also. This is done by the CEO.
We had an experience, a very traumatic experience in the markets back in 2008 and 2009. Once the markets dropped, a lot of clients actually bailed out of their equity mutual fund positions. What we saw on the opposite side with Dimensional and the advisors working with their clients, and the rebound in the markets from March of 2009 forward was dramatic. And fortunately, the advisors' clients who kept their assets deployed in the market were able to benefit from that increase in the performance of the stock market. What the advisor does is spends time with the client, basically gives them discipline around the process, around their investment policy statement, and really helps the client stay in the markets through good markets and bad.
Yes, again, let me just echo some of the key points of it, which is when it comes to investing, there needs to be discipline, especially if you are new to investing, or if this investment you're intending to do is for a big goal and amounts are big. That's where having advice works really, because avoiding mistakes is all that matters, because investing has a lot of emotions triggered with it, and staying the course is not as easy as it sounds. Let's deep dive back to the point on what dimensional fund actually practices in terms of its investment approach. They actually have a three-factor model. I'll leave links below just in case you're curious to find out what does Investopedia mention about it, especially the exact dynamics. But I'll screenshot for you as you can see over here. Three-factor model. First thing is market risk. Second thing is company size. They are looking to overweight more on smaller companies. And the third part is on value factors. Value factors are companies that have better book to price ratio. And in this category, it's more on value investing versus growth investing. So while they are going to have large caps within the fund itself, later I'll show you details of it, they are trying to overweight for you using even a passive approach. So again, overweight on small cap, overweight on value investing, but still a very passive approach. That's why the cost is actually kept to a very minimal amount. So the formula of it, which I'll pull out for you to see, is a very complicated model. This portion, unless you are a mathematician or unless you understand financial engineering, this is not too easy, but it's actually the modeling whereby Eugene has actually won a Nobel Prize with it. So now let's move on to another key component that they have actually mentioned out in public. So they have also highlighted when they have this investment approach, in the short period of time, there can be volatility, extra volatility, as well as underperformance for periods. Now, even Warren Buffett actually underperforms the benchmark at certain periods of his investment horizon. But nonetheless, when you stick long-term enough, the principles are going to work in your favor. How long-term? 15 years. That is highlighted in this statement over here. So now let's move also to the third part. What are some of the key dimensional funds? There are three which I'd like to highlight to you. The first one is actually the emerging market. The second one is actually the core equity market. And the third is actually the 60-40 allocation fund that they have. This 60-40 fund is 60% belongs to equity, 40% belongs to bond. So this is actually a fund whereby if you are a balanced risk investor, this is something that I'll suggest for you. If you're looking to buy into equities, then the first two will work a lot better. So now let's move to the emerging market portion of it. You'll see over here that the top allocation is China, followed by Taiwan, Korea, Brazil, and then India. So everything really in the emerging market space. Total number of holdings, 923. Extremely diversified. Now, this gives you exposure to emerging markets. If you believe emerging markets are the future, then this is a right allocation for you. Having said that, emerging markets have a slightly higher cost. I'll highlight for you to see over here. Annual management charge is 0.45. Let's compare that to the core equity, so which is the developed markets. You see over here that core equity, the annual management charge is 0.3. Both of these is extremely low already. ETFs are also around this 0.3, 0.4 range. Mutual funds are 1 to 1.5 range. So in a lot of ways, this is a very low cost investing approach, very passive and yet also very low cost. So now let's move to details of the core equity fund. As you can see over here, the core equity fund actually has more than 7,700 allocations, which means you're very broadly diversified. And into which regions? The top region is US. So this is going to track the S&P quite closely. So you have to firstly feel S&P is a worthy investment. As of now, I personally suggest having more allocations towards emerging markets and Asia in particular. I've shared before in this community many times that book value of emerging markets are more expensive in general. So again, a portfolio we can add in further preferences and customize it further for your investment goals, as well as what is the investment climate in the near term. So what you can see over here is there's a lot of allocation towards IT. The top holdings are in Apple, Microsoft, Amazon. So these are big caps. But reiterating again, dimensional funds allocate towards value investing and allocates a little bit more towards small cap. So now let's see on a short-term basis. I'll pull out for you to see in this chart over here. You see the 3 months performance, everything is down. In fact, they mirror each other so closely. The emerging market has China and has Brazil. China has lost very little in this pandemic, but Brazil is really getting beaten up. So on average, they've lost, as you can see over there, very similar to developed markets. But when we look towards a 2-year assessment, you realize that in the developed markets, which is under a global core equity fund, the red line, has outperformed significantly. On a value perspective, then perhaps emerging markets are slightly better. It doesn't mean that they've underperformed, they are not worthy of your investment. You must really look in terms of what is going to happen in the future. So again, that depends on your investment goal, that depends on your investment risk appetite. So with that, I hope I've covered with you and give you a glimpse as to how dimensional funds actually work. They can be a very crucial component to your investment strategies, and they can be a crucial component how to contribute towards your retirement planning. If this is a topic that interests you, look for my links below. We can get together for one-to-one discussion. And again, if you are new to this community, click on subscribe. I'll be launching videos every week to share with you on financial ideas. And I'll touch a little bit more on retirement planning down the road, because I think that's something that really impacts someone who's 20 as well as someone who's 50. So again, with that, I'll thank you for watching. I'll sign off from here. Click on like so more people can see this valuable content. See you in the future video. Take care and goodbye.